Hello everyone, this is Blago. Today we're going to talk about creating a financial model for a software development business in less than 30 minutes. And we're going to use Modlix for doing that. Let's not waste any time, let's jump directly into Modlix. This is Modlix. In order to create a professional financial plan for a software development business, or for any business for that matter, you would have to provide assumptions about your business for the following areas: your revenue assumptions, cost of goods sold or your direct costs for your business, employees, expenses or operating expenses, your assets that you need in order to run the business, any financing that you require, taxes, and working capital. And as you provide assumptions about your business, your financial reports for your financial plan would automatically be generated in Modlix. And the financial results or the financial output are three main financial statements when it comes to a financial plan or a financial model for a company. And that is your profit and loss statement, your balance sheet, and your cash flow statement. So let's start with revenues. The best way to structure your revenue calculations for a growing software development business is to organize your revenue streams by size of clients, meaning, let's say, a small client, a medium client, and a large client type. And then for each client type, we would calculate the average number of billing hours per client per month and per year, and the hourly rate for that size of a client. And then we would calculate the total revenues. So let's see how this would work in Modlix. Now, let's first, we have started here using a financial model template from Modlix for a professional services business. And if you start using this, if you start with the financial model template, you would be able to complete your financial model in less than 30 minutes, because the whole logic of the business is already pre-built into the financial model template. So let's see now. First, here in the template, we have defined three revenue streams. There is a service revenue 1, service revenue 2, and service revenue 3. But for a software development business, as I said, I would organize the revenues by client size. So first thing is, let's edit these names and make sure we change them to something that we can recognize better, meaning revenue from small clients revenue, edit medium clients revenue, and then the third one would be large clients revenue. Calculate our revenues. First, small clients. The small client revenue will be calculated as the total number of billable hours that we're gonna generate from all of our small clients, multiplied by the hourly rate that we charge on average for small clients per employee. So now first, let's calculate the total number of billable hours. We're going to calculate the total number of billable hours for small clients by multiplying the total number of customers that we have by the percent of total customers that are small customers, multiplied by the billable hours per small customer. So let's say this is a startup business. So at the beginning, we have 0 customers. And then we expect to have a total number of new customers. This is not only small customers, but total number of new customers. We expect to get, let's say, 2 customers every month. Say 2 customers every month for the first 3 months. And then let's say that we plan to pick that up to 3 customers per month, new customers. And then let's say we pick that up to a total of 5 new customers per month, and we don't expect to grow any faster than that. So we're going to copy paste those numbers all the way to the end. Now, the next thing to define is the number of churn customers. We're not going to be able to have these customers forever, although that would be great. So let's say that every month we're going to lose 1 customer. We're going to lose every month from our total customers. Now we have defined the total number of new customers and churn customers for our business. Next is to define what percent of these total customers that we have are going to be small customers. And let's say that about 50% of them are going to be small customers. And let's say this will not change all the way through the planning period. And then we just need to define two more things. One is the billable hours per small customer. Let's say that we have on average for a small customer, one developer per month. So this will be say about 160 hours per month. We'll just copy paste that all the way to the end. And that will be 1,920 billable hours per per customer, per small customer per year. And then the hourly rate that we charge is going to be somewhere around, let's say, $50. Copy paste that all the way to the end. Now, and then to sense check just these numbers is to also see whether when we multiply the billable hours per small customer, 160 multiplied by 50, which is going to give us $900, whether or $800, whether this makes sense as a total project cost for a small customer. Let's say that $800 per month is what we on average charge our small customers. So we're happy with those assumptions. Next, we go to the medium clients. Open up the billable hours. Now the total number of customers is already predefined there. And now let's see what is the percentage of total customers that are medium customers. Let's say that this is about 30% of our customers are going to be medium customers. Let's say this is not going to change. And we have about 320 billable hours per month per customer. And the hourly rate is, let's say, on average $60 per customer. Again, just to sense check those numbers, 320 hours times 60 would be around 1,800, about almost $2,000. Does this make sense per customer? Does this make sense for a monthly charge per medium customer? Yes, that makes sense. So let's move on to large customers. Large customers, we would have, again, we have the total number of customers there. Let's say that about 20% of all our customers are large customers. And the billable hours per large customer now, let's say that these are about 1,200 billable hours per customer. And we charge large customers about, again, $60 per customer. Copy paste these numbers all the way to the end. And now we have calculated our total revenue from for our software development business. That's it. It's as simple as that. Let's see what we got to. We have a total of $24,000 in the first month per month, and that is growing as we keep acquiring new customers all the way to 37 million. That's a healthy growing business. Maybe we would have to consider whether our customer acquisition or number of new customers is maybe too high. But for now, let's keep this as it is. So let's move on to the next section, which is cost of goods sold. Now, cost of goods sold are the direct costs for providing the services, our software development service. And we have direct costs, which usually could be calculated as a percentage of the revenue that we generate. Plus, we have direct labor, which is going to be the salaries of our consultants, and usually, and the third usual direct cost that a software development company has would be payment processing, in case we're charging our clients through credit card, and there is a credit card processing fee that we would usually pay. So, as direct cost, let's say that about for small clients, that about 10% of our revenue is of our small clients' revenue is direct cost for our business. This could be things like any travel expenses that we have for clients. This could be any server costs that we have in order to provide the services that we're using, any infrastructure cost, any licenses for products that we're using, software licenses for products that we're using in order to provide the services. So let's say about 10% of our revenue would go into direct costs, and same for medium clients. Let's say 10% of their revenue would be direct costs, and then for large clients we would have also about 10% of our cost would be direct cost. Then payment processing. Payment processing as a percentage of total revenue. Now, we could have broken this down further into what percent of the revenue is charged through credit card, but for simplicity reasons, we've just kept it as payment processing as a percentage of revenue. And let's say that about maybe half of our revenue is paid through credit card, and the cost for processing those credit card payments is about 4%. So we're going to say 2% of our total revenue is going to be credit card processing fees. And let's say that we don't expect this to change, so we're going to copy paste 2% all the way to the end of the planning period. Next, direct labor. Now, I'm going to move on to employees. I'm going to define the direct labor costs over there. So when it comes to the direct costs outside of direct labor, those are the only inputs that you would require for a software development business. So now let's move on to employees. Now here we have several types of employees, and these employees come from the template. If you're a larger software development company, you might have different positions, so you can always add new employees. Or if you're a smaller company, you can remove any of these predefined employee types that we have here just by deleting them. So for this example, let's look at first the direct labor. And these are the consultants. These are the software engineers that we have in our team that are generating our revenues. So first of all, let's say that we have four types of software engineers. We have a junior engineer, we have a senior engineer, we have an architect, and we have a specialist. So let's start with junior engineers. How are we going to calculate the salary cost for junior engineers? Well, we're going to calculate it based on the total number of junior engineers that we will need, and this is the employee number, and then the employee cost, the total gross salary on average per junior engineer. So we're going to edit. First thing, we're going to change the name of this employee type. I'm going to say these are junior engineers, and we're going to go next. Now, in order to calculate the number of junior engineers that we need, we have set up a formula here within Monolix. The reason is, when you have a growing business, you should directly connect the total number of staff that you need to the revenues that you're generating. So whenever you change any assumption on the revenue side, it will also automatically change the number of employees that you need in order to generate that revenue. So the logic for calculating the number of junior engineers that we have will be as follows. The number of employees will equal to the total number of billable hours that we have, that we're going to charge all our clients. And we already calculated that when we set up our revenue assumptions, multiplied by the percent of the total employees that are junior engineers, or percent of the total billable hours that are being provided by junior engineers, or employee class 1. Then we'll divide that by the utilization rate for junior engineers. Not always all employees are 100% utilized and billable to clients. So we need to assume a utilization rate for our employees, and then we will divide that by the total number of working hours per period. So the total billable hours that we have for our business is already calculated, because we defined that, as I said, when we calculated our revenues. So now we need to define what percent of these total billable hours are being provided or being worked on by junior engineers. And let's say that about 50% of total billable hours are done by junior engineers. Let's say this doesn't change in the future. Then what is the utilization rate of junior engineers? Usually it would be close to 100% because junior engineers don't have any additional responsibilities outside of actually coding for clients. So, but just to be on the safe side, let's say that about 95% of their of all junior engineers' time will be billable, will be utilized. Then the total number of working hours per period. On average, in a month, there is about 160 hours, 160 working hours per month. But there are holidays, there are vacations. So we'll assume that there are about 140 working hours in each period on a monthly basis, and 1,680 working hours on annual basis. So that's it. We've entered those three main assumptions. What percent of the billable hours are done by junior engineers, their utilization rate, and the working hours per period. Then we go next into our cost per employee. Now, this is the total gross salary that we pay as a company to junior engineers. And let's say they cost us about $3,000 or $4,000 per month, total gross salary. That's it. Click Save and Close. And now, the total number of junior engineers that we need in order to achieve these revenues that we defined in the revenue step have already been calculated. See, we would need first, we start with 2 engineers, and then it goes all the way up to 202 junior engineers that we would need in order to achieve the projected revenues. So let's go next. Let's go to our next employee class, which is going to be senior engineers. I'm going to edit, call it senior engineers. We'll go next. Now, same logic again. What percent, this is the total billable hours that we have. Now, what percent of the total billable hours are worked on by engineers, by senior engineers? And let's say this is about 30%. 30% of our staff, that means would be senior engineers. What is their utilization rate? Say about 90% of their time is utilized and billable. And the working hours remain the same for them, 140 billable hours, 140 working hours per month for our staff. Not save and close. I forgot to define their salary. So we can do that directly here for the senior managers, the senior engineers. We have the employee cost, and let's say we pay on a total gross salary of $7,000 for senior engineers. Next is going to be our third type of employees, direct employees, and these are going to be, let's say, architects, software architects. Same logic, say about 10% of the billable hours are done by software architects, and they have a utilization rate of 90%. Now we've calculated the number of employees that we would need, software architects employees. We go to the cost per employee, and here we say we pay them, let's say again, $7,000 per month. Actually, for all types of employees, if we expect, and usually we would expect that there will be salary changes, we can either just make the changes directly into the inputs here, or we can use this percent growth functionality where we say the starting salary is $7,000. We don't increase the salaries in the first year, but then we expect a 10% increase per year on the average salary. And then the total average salary will be calculated using that growth rate. That's it. We click Save and Close. And finally, the last type of employee, direct employee that we would have, let's call them Q&A. Q&A. And same logic. What percent of the total employees that we have are going to be Q&A? Let's say it would be 10%. Utilization rate, 90%. That's it. We've calculated the number of Q&A employees. See, so we had 50% junior engineers, 30% senior engineers, that's 80%, and 10% each Q&A and architect. So that's 100% of our direct staff being calculated in the model. So we go to cost per employee, and let's say that we pay Q&A team $3,500 gross salary per month. Close. And that's it. Now we have calculated our total number of employees, direct employees that we would need in order to generate these revenues, and the total cost for those employees. And then we move on. Then we have a marketing team. Here we'll simplify things and we'll say, okay, how many marketing people we need? Let's say we need one person for year one, and then we expect to hire one more person next year, and one more person the year after that. We pay them $3,000 per month. Maybe we increase that to 40,000 per year, and then 45,000 per year in the last year. Sales team. Okay, we need 2 salespeople for the first year, and then we hire another 1 person every year after that. Now we could also set up a formula to calculate the total number of salespeople that we need. And we can easily do that. And let's actually do that. Instead of just hard coding the number of salespeople that we need, let's go ahead, go into the sales team. Go into edit. Instead of hard coding the total number of salespeople that we would need, let's set up a formula where we would say, in order to calculate the number of salespeople that we're going to need, we're going to use the total number of new clients acquired divided by a number of clients that we can expect one sales employee to acquire in every period. So let's add the 2 drivers. First, we're going to create a new driver, which is going to be the new clients per sales rep. It's going to be a number of new clients, and it's going to be a sum. Create. And we're going to add a second driver, which we're going to select from existing, and we're going to search for new clients. So we're going to find here new customers. Then we're going to come down here and we're going to set the formula. We're going to say, we're going to round it up, total number of new customers divided by the new clients per sales rep. We're going to close the parentheses. I'm going to set the formula. Now we have the new customers here already defined when we define our revenues. So now it's just for us to define how many new customers, new clients can one sales rep close per month and then per year. So let's say one sales rep can close 1 customer on average per month. And with that, now we have calculated the total number of sales reps that we need. It's not a hard-coded input anymore, but it's calculated based on this logic. So then we just go to the cost per employee. And we say, okay, we're going to pay $4,000, $4,500, let's say, per sales employee. Close. And now we have calculated the sales employees and their cost for acquiring all these new customers. Now we're going to move on to, that was the sales team that we just defined. And then let's say we have a CEO, which is 1 person usually. Say 1 employee, a CEO, and their salary is going to be, let's say, $8,000 per month. Then human resources. Say we need 1 person at the beginning, but we need to ramp that up quickly because we are hiring a lot of people. So let's say 1 person at the beginning for the first couple of months, and then we need to ramp that up to 2 people. Then ramp that up to 3 people. And again, we can set a formula here as well, where we say that we calculate the number of HR employees that we need based on the number of new employees. But for sake of simplicity here, I'm going to keep the inputs hard coded. So 4 people, and then let's say we need 6 and 10 people the years after. And the salary we pay to them is, let's say, $3,000. That's the employee cost, $3,000 per month. That's it. Finally, office support. Finally, office support employees. Let's say we need 2 people to start with for the first year, and then we need to increase that to 4 and 6 people after that. And their salary is $2,500 per month. And with that, we have finished calculating our employee costs. Now, again, as I said, you can, if you have other types of employees, you can easily add them by clicking on the Add Employees button here. Or if you need to delete any of these employees here, you can easily delete them by clicking the little trash can here next to the employee type. Next, we move on to expenses. Now, a software development company would usually have marketing expenses, sales expenses, and then other general and administrative expenses like rent, utilities, software licenses, travel and entertainment, office supplies, professional services, and any other expenses. So let's start with marketing. Marketing and sales expenses, we can define them either as a percentage of the revenue that we generate. So let's say we plan to spend about 10% of our revenues on marketing expenses. And then we can say we plan to spend about another 10% of our revenue on sales expenses. Or if you want to go and be a little bit more detailed, we can add a new expense for new customer acquisition. New customer acquisition, so the sales and marketing expense. And then we set up a formula where we calculate the new customer acquisition based on 2 variables or 2 drivers. One is going to be the number of new customers that we acquire, which we defined when we defined our revenues. So we're going to click select from existing, and we'll find here new customers. Here's number of new customers. And we're going to use a second variable, add a driver, a new one, which is going to be a cost per new customer. It's going to be a dollar value and an average. Click create. Now we set up a formula where we calculate the new customer acquisition cost as the number of new customers multiplied by the cost per new customer. Set that formula. Now the new customers are defined already over there, and we're going to say it's going to cost us about $3,000 to acquire a new customer. Copy paste that all the way to the end if we don't expect it to change. Click save and close. Now we have set a formula where the new customer acquisition, the number of new customers, is directly linked with the marketing expense based on a customer acquisition cost. Next, we move on to our general administrative costs. And here, just we know how much rent we pay. Let's say we pay $2,000 rent per month. Then we have our utilities. Let's say these are about $500 per month. We have our software licenses. Pay $600 per month. And so on. We define all our expenses. Now, we could also be a bit more detailed and link all of these expenses to a specific driver which drive this expense. So, for example, our rent will have to increase over time. Let's say we start with the $2,000, but we keep as our team grows, we need to grow our our offices as well in order to fit all these new employees. So the way we can do that is we can say that the rent could be, you can go into edit of rent, and instead of inputting the value, we can say, okay, we're going to set a formula where our rent is going to depend on the total number of employees that we have. So you click here, select from existing, total employees. Let's find total employees, total number of employees. And we're going to say that we're going to pay rent, new driver, rent per employee, rent per employee. Great. Then we're going to say our rent is going to be equal to the total number of employees multiplied by the rent per employee. Go next. And you see we are scaling up our team to a total of 400 employees. So if we pay, let's say, $20 per employee, our rent will automatically scale up as we scale up our team. So we click Save and Close. And we can use a similar logic for all our expenses where it makes sense that our expenses are directly linked to a specific variable that drives that expense. This is how you create a driver-based model, which is the only really right way to plan about especially a growing business. Same with utilities, same with software licenses, travel and entertainment expenses. Everything usually depends, or most of the expenses, unless they're fixed, they depend on a specific driver, which influences that expense. So, for example, we go into other expenses and we say, at the moment they're set as a percentage of total revenue. We can keep that, or we can say we can delete other expenses. We can create a new one, new expense, which is going to be their office expenses, which is going to be a general administrative expense. And we're going to say the other office expenses, we're going to set a formula and we're going to say it's going to depend on two variables. One is going to be the, again, total number of employees, and the second variable is going to be a office expense per employee. This is going to be a formula where total number of employees multiplied by the office expenses per employee. We set the formula and we say that it costs us about $100 per employee in other office expenses. Save and close. And that's our office expenses calculated. If we look at our travel and entertainment, this might actually best, it will either depend on the number of employees, but most likely this is going to be a percentage of revenue, because as we grow, we have to travel to more clients' locations. We have to entertain more clients. So what I would do is I would edit, and we'll say travel expenses is going to be equal to, set a formula. First variable is going to be select from existing. This is going to be revenue. So for travel entertainment expenses, this is usually going to be either you can have it as a hard input, or it would usually depend on how much revenue we generate. Because the more clients that we have, the more revenue we generate, the more travel and entertainment expenses we're going to have. So let's say we're gonna delete this travel entertainment. I'm gonna create a new one. New expense, travel and travel. It's gonna be general administrative. Next, oh, sorry. Go back to general. I'm gonna set it as percentage of total revenue. Then we're gonna say that about 4% of our revenue is gonna be travel and entertainment. Click save and close. Professional services. Again, you can either hard code an input, and usually this would be the right way to do it, because this is not really dependent on revenues or any other variables. So we're going to say, we have some accounting, lawyers, lawyer fees, any audit fees. So let's say it's about per month. It's going to be about let's say $2,000 per month, and on annual basis, it's going to be $24,000. But as we grow, maybe it's going to be $50,000. It's going to be $100,000. And that's it. We've defined our operating expenses. Next, we're going to go into assets. When we create assets for a software development company, now there are a few options here in the financial model template, which is there's equipment, vehicles, and furniture. But specifically for a software development company, what I recommend doing is just having one property, plant, and equipment asset line, which we're going to set as, and we're going to use it as equipment here. I'm going to edit. Next, and we're going to set a formula where we calculate the number of assets that we need. And by assets, I mean computers for our employees, desks, any other assets, office assets for our employees that they need in order to operate, to work. So we're going to set a formula. We're going to say, we're going to calculate the number of assets that we need to invest in or buy over time based on the number of new employees that we get. So so we're going to select from existing first variable. It's going to be new employees, number of new employees. And then we're going to have a second variable. It's going to be assets per employee. Per employee. And we're going to have number of new employees multiplied by the assets per employee. That formula. This is the number of new employees that we have. I'm going to say it's going to cost us about $2,500 per employee in terms of assets that we need for them to operate. Save and close. That's it. Our assets now have been automatically calculated for our business. Next, now what we see is that we have here model externals that your cash balance must not be negative. It's negative. So you need to increase your cash inflow or decrease your cash outflow. Now, what we see is that we keep our cash balance keeps growing negative, which means we're probably not profitable with the business as it is. So let's go back. Let's go now to the report section. We'll go into profit and loss and see how our profits look like. Yeah, our EBITDA, our operating profit, keeps going negative, which means we have too many expenses for the revenues that we generate. And when you model your financial your business, when you model your financial plan, usually there will be a back and forth between inputting assumptions about your revenues, about your costs, and then looking at the outcome, your profit and loss statement, your cash flow, and then adjusting some of those assumptions. So I think we're going to need to go ahead and remove some of these expenses that we have in order to make this business profitable. So let's say marketing expenses, we're not going to have any marketing expenses because we added a new customer acquisition expense. So we're going to set this at 0. We're still negative. So based on the salaries that we've defined, very likely that our hourly rates are a little bit too low. So we said that the average hourly rate per small client is going to be $50. We probably need to increase this to about $70. We have hourly rates for media clients. Let's say it's $70 as well. And our hourly rate for large clients is, let's say, it's going to be an $80 on average. Okay. Now let's look at our reports. Profit and loss. Now we have become positive. We are making profits. So going back to assets now, what we see is that we have negative assets, negative cash, going up to about 259,000 negative cash, and then we start to become profitable or cash flow positive. So then we will then we start making profits, and our cash balance becomes profitable. So in order for us to start this business, basically what this tells us is that we need about $260,000 of an investment upfront in order to start the business and then fund the business until it becomes profitable. So we're going to go into financing here, and there are a few options when it comes to financing. We can get a bank loan for $260,000, or a line of credit, which is still a bank loan, or we can have shareholder investment of $260,000 in order to fund this business, or it can be a combination of both. So let's make it a combination of both. We're going to go into first shareholder investments. We're going to go into edit. We're going to say we're going to invest $50,000 into this business in the first month. Click save and close. Now we know that we need another about $210,000 until we start becoming cash flow positive. So let's say I'm going to look at this bank loan. We're going to go into edit. I'm going to say in the first month, we're going to get a bank loan of, just to be safe, $250,000, let's say. We're going to pay it back in 60 months with an annual interest rate of 5%, say 6%. There's no grace period, and we're going to pay back this loan monthly. So with just these few inputs, the full cash flows from this bank loan are going to be calculated automatically. We click save and close. Now, if we quickly go back into assets, we're going to see that our cash is always positive. So our business is funded properly. We'll go next into taxes. Usually, there will be when you plan for your when you create your financial model. Usually, the only tax you take into account is the income tax, which most countries will have a certain income tax expense. So we're going to go into edit, and the only thing you need to define is what is the income tax rate in your country. Let's say it's 20%. Income tax rate. Do you expect this tax rate to change in the future? Unless you know for a fact that the government is planning to change the tax rate, that you will keep as a no. Click save and close. And that's it. Now our income tax has been calculated. It's zero in the first month because we are making a loss in the first month of our business, and then it starts to we're starting to pay income taxes once we become profitable. Finally, working capital. Only a few inputs here. What does this mean? The working capital is the operating. It helps you define how much money your customers are going to owe you at a specific period of time, how much money you need for inventory in case you have inventory, but because here we're talking about a software development company, usually there will be no inventory, and how much money you're going to owe to your vendors for the services and products that you buy from them. So how do you calculate this? A few simple inputs. Credit sales, first accounts receivable. How much money are at any point of time our clients going to owe us? What percent of our revenues are going to be paid on credit terms, meaning that we invoice our clients and they get certain number of days. They don't pay right away. They get certain number of days to pay our invoice. So let's say 100% of our invoices are paid with a payment terms of 30 days. Our clients get 30 days to pay our invoices. Inventory, as we said, software development company, so usually we don't hold any inventory, so that will remain zero. And then accounts payable. What percent of our purchases the products and services that we buy in order for our business to function, we will pay on credit terms. And let's say that 100% of our purchases we pay with 15 days payment terms. And with that, we have defined our working capital. And now that's it. We're done with our financial model. Let's go into our reports. Here's our profit and loss statement. We see that even in the first year we become profitable on net income basis. We see our revenues 5 million, 30 million, and 48 million. Very fast growing, very quick and rapidly growing business we have created here. And we can look at it the first year on monthly basis if you want to see more detail. Then we look at our balance sheet. Here's our balance sheet. We see that's our current assets, that's our cash balance, accounts receivable, and so on, all the way down to equity. And we see our cash flow statement. What we see here is that we have this is our net income, total calculation to net cash from investing activities. This is the assets that we purchased. Remember, for every new employee, we bought office equipment for them. So that's the assets that the money that we need to invest into assets for our employees. Then we have our loan, bank loan that we bought, and we have $50,000 equity investment in the first year. So what we see is again now that our cash balance is negative. Now, this is because of the inputs that we put into taxes and working capital, which means that again, we will need some more cash investment into this business in order until it starts becoming cash flow positive. So we're going to go back into financing. We're going to say, so we will need additional 660,000. So we're going to go back into financing. We're going to say, okay, we're going to have to invest more money as shareholder equity. Let's say we will invest, instead of 50,000, we'll have to invest 200,000. Save and close. And then we're still going to need to increase the bank loan that we get from the bank. And let's say that we're going to increase that by another 500,000. So if you go into the bank loan, so this will be $750,000 of a bank loan. Save and close. Now, if we go back we can either go back to assets and see, we're still cash flow negative. We still need about 117,000. Okay, so let's go back into financing, and our bank loan is going to be 1 million. 1 million bank loan. Now let's look at our assets. Now we have become cash flow positive. Again, go back into our cash flow statement. See our cash balance being positive and then keep growing. That's it. We're done with our financial model for a software development company. I hope this was helpful. If you need a financial plan, subscribe to Modelix today. You can have it done within the day today, and then start managing and growing your business professionally with your financial with the help of your financial plan. See, what Modelix allows you to do is to build a driver-based financial model for your business. When you connect logically your revenues and the costs and the employees that you need in order to achieve those revenues. And you see, as you build your model, what we saw through this example is that you can quickly see whether you're profitable or not, whether you need to tweak any of your revenue assumptions, any of your cost assumptions, if you need to get more financing for your business in order to until it becomes cash flow positive. So it's all dynamic. You can quickly see the impact of any changes that you make to your assumptions within Modelix, and create a financial model that will help you grow your business faster. That's it for this session. Hope it was helpful. Have a great day, everyone.